Ever wondered how credit risk funds work? Well, you're about to find out. At their core, credit risk funds are a type of mutual fund. They primarily invest in corporate bonds that have lower credit ratings. Why, you might ask? It's because these funds aim to earn higher interest. They're a bit like the mavericks of the investment world, taking on more risk for the chance of greater returns. To give you a more concrete understanding, let's consider two examples of credit risk funds. Example 1. A fund that invests in corporate bonds of a startup tech company. This type of fund might be seen as risky, as the company is still in its early stages and may not have a proven track record. Example 2. A fund that invests in bonds of a company in the hospitality industry that has been hit hard by recent events. This could also be seen as a risky move, as the company's future is uncertain due to the impact of external factors. Now that you've got a grasp on what credit risk funds are and how they can look in practice, let's delve into how they're composed. Credit risk funds have a unique portfolio composition and investment objective. Now, the aim here is to generate higher returns, but it's not without taking on more risk. These funds typically hold a mixed bag of corporate bonds, some that are higher risk and others that are lower risk. The strategy is to balance out the risk, while still striving for those higher returns. But remember, with the potential for higher returns comes the potential for higher losses. With higher risk comes the potential for higher returns, but also higher losses. Let's explore that next. Credit risk funds offer an intriguing balance of risk and return. They promise higher potential returns, but with that comes higher risk. These funds are not for the faint-hearted. Rather, they are ideal for those with a higher risk tolerance, who can stomach potential short-term losses for long-term gains. This is why they are often recommended for investors who have a longer investment horizon. Now you might wonder, how do these fund managers assess and monitor these risks? Well, let's find out. Fund managers use a variety of tools to assess and monitor credit risk. A crucial part of this is credit analysis, where they scrutinize the creditworthiness of the issuer. They examine financial statements, track industry trends, and monitor market conditions. The goal? To minimize losses while maximizing returns. They're like detectives, always on the lookout for clues that indicate a potential risk. It's a delicate balance, but one that's essential in the world of credit risk funds. But what about taxes and regulations? Let's tackle that next. Like all investments, credit risk funds are subject to taxes and regulations. The tax implications vary based on the holding period. Investments held for less than 3 years are subject to short-term capital gains tax, while those held longer are subject to long-term capital gains tax. As for regulations, these funds operate under the purview of the Securities and Exchange Board, ensuring transparency and investor protection. Now that we've covered the basics, how do credit risk funds compare to other debt fund categories? Credit risk funds have some key differences compared to other debt fund categories. They often promise higher returns, but remember, this comes with a higher risk factor. These funds are not for the faint-hearted, but for those seeking a thrilling financial ride. To wrap up, let's quickly review what we've learned. So we've covered a lot of ground today on credit risk funds. From understanding their portfolio composition and investment objectives, to delving into their risk and return dynamics, taxation and regulatory aspects. Remember, investing always comes with risks, so do your homework and consult with a financial advisor. If you found this video helpful, don't forget to subscribe for more. Until next time, keep investing wisely.